It is great to be back in the black hole of real estate. And this week, I want to talk to you because we are heading into the last part of the first quarter of 2024, and it's turning out to be a year like we predicted that it was going to be a difficult year for some industry professionals because the work required is different than the work was required the last few years, and we're starting to see the pain points being hit. Agent count is dropping nationwide. There's still talk of lawsuits that are happening. In the meantime, the best of the best are doing really well right now. So, hey, it's Ron Wojciechowski, and first thing I want to touch on right now is that we're in this time where the rates didn't slide down like many people anticipated they might, and I'll put myself in that category. I figured they would drop pretty much every meeting this year to get the rates down to something pretty cool by election time. And right now we're hovering in that space, in that 7-ish area for interest rates in a 30-year mortgage, which historically is a great rate. And if you look back at all the run-ups of great economies, that was about the rate. And it was only when it was artificially suppressed, down to the 2s and 3s, that you saw that type of activity. So it's very uncommon, probably once in a lifetime thing you see a rate like that. And right now the rates living where they're living. For many people, it's an issue, at least emotionally and psychologically. When you've got to move, and it's the choice between staying where you are that doesn't work or buying instead of renting, at some point, the pain of being where you are overcomes the pain of that rate. And I think enough people are moving forward. There's buy downs available, and there's plenty of ways to refinance down the road at little or no cost from the lender fees. Most lenders have jumped on board with that to keep business going. But from the agent perspective, they're 2 months in. Some haven't had a closing. A lot have not had a closing the first couple of months. If there's nothing pending, they're going to get shut out in the first quarter. And 25% of the way through the year with nothing closed and nothing pending, it's getting to be a tight squeeze for many agents right now. And many board dues come due throughout the year, whether it's MLS fees or halfway year dues, and they're all offset by certain time parameters. I think what you'll see is a steady decline in the agent count, and at the very least a lot less coming into this market because it's tougher. There's always going to be people entering this business, and the best will stay. And interestingly enough, the ones that don't sell hardly anything, they stay too, because they probably have a main job that brings in the income they need to live on. And so if they sell one every few years, it covers the board dues, and if they sell a couple, they're making money. It's that group in the middle we talk about all the time. Not the top 20%, not the bottom 50%. It's the 20% through 50%. They're the ones most at risk right now. And if they're not increasing their skill habits, increasing their activity levels, and getting really, really solid practice in the fundamentals of real estate, those are the ones most at risk right now. And I think you're seeing it. And you're hearing it. In the agent community, it's not too many days where somebody will be mentioning how hard it is or the difficulties in the market. And for others, hey, this is a great market. There's opportunities out there for buyers. Sellers can go on the market and not be completely terrified that there's nothing to buy. Contingent deals are working, and there's ways to get through the inspection periods, even if there's repairs and credits going on. So it's just a normal market. And it's pretty good right now. So if you are a consumer and you're selecting an agent, I would do my homework. I would check reviews. Hey, I just ask, hey, how's the market? How's your business? And if you get anything that's not uplifting, you may want to continue the interview process until you find somebody that's going to be able to meet your needs and be focused on finding the right home or selling for the most amount of money, as opposed to scratching for a check and maybe, I don't say compromising your interests, but if somebody sounds a little bit desperate for a check, it may not be the best negotiation for you and your personal interests. And I would just really take into account the skill of the agent. Trying to save a percent, and we always talk about the splits sometimes are for losers. Trying to save a percent and saving $2 or $3 grand maybe on your purchase, that's fine. But if you lose 10 or 20,000 in their purchase price, it's not so fine. So I would just trust your process, whatever it is, and be thorough when you select the right agent, and be thorough when you have these conversations and negotiations. So let's walk away from the interest rates. I think that it can almost get to be a tired subject, and we know inventory is trickling upwards right now. But what about the rest of the market? There is this insurance thing that's not going away in the condo space, especially. Now, insurance is up across the board, 20, 30, even 40% in some areas, and it's going to go up again next year. But we're seeing more and more that the associations where the condos are, they're just not keeping up. Balcony repairs and roof repairs, they're being asked for by the insurance carriers, so they're going to drop the coverage on a building. And I'm familiar with a condo that has an assessment coming up. The insurance company is giving them to May to get a roof done, which is not a lot of time. And there's a good, better, best option. One would probably be a $6,000 assessment, one a $12,000, and one for $15,000. And when you think of a building with about 65 or 70 units on it, and they're paying $15,000 a piece, it's over $1 million roof. If they do the best, the good, better, best, do the best one. Not everybody's got 15 grand. They just stroke a check and say, okay, put a new roof on there. So a couple of things are going to happen with that. Those that can pay, they'll pay it. If there's a loan program, that'll make the HOA fees go up every month. That'll make it less affordable. There's only a couple ways to do this. And I suppose there could be a special assessment and an increase of fees. There could be a small business association type of a loan or something else, a line of credit on the association's part. Each come with a price to it. For those that can pay for it, it's easy. For those that can't, this is where the fire sale may happen. And let's suppose everything's going for $250,000 in the building, but you've got a $15,000 assessment. Will it sell for $230,000, $225,000? Some number less than $250,000, probably. And the buyer will say, look, we'll take on the assessment, and that'll be it. Or the seller might say, look, give me the $250,000, but you're going to pay out of proceeds. You're going to pay for it somehow, some way. And most offers are written where the seller pays for that fee. So if it's the big one at $15,000, they might sell for $250,000, but subtract out $15,000. It's $235,000 before closing costs and commissions and other fees. So there's going to be a smaller net. But the minute that one owner in a building capitulates, that sets the new bar, higher or lower, for the pricing of all the rest. So it's a tricky time if you're in a condo that is blindsided by another assessment. That very building that's having the roof assessment just had a balcony assessment, and that was just paid off, and that work is just about done after 2 years, and now right around the corner, now you've got the roof one, so they can come in multiples. So I would just keep an eye on the condo market or anything that might be subject to some sort of a special assessment or an insurance increase. The scary thing is that a lot of these buildings, they got the big assessment, they're raising the HOA fees, and the only way to make it come down is to get rid of something vital, and that's probably the replacement cost on the insurance of the building. It is far less expensive to insure a condo building for less than full replacement cost. That would make sense. However, when you do that, it pretty much knocks every traditional lender out of the box, because they're not going to lend on a condo in a building where there is not a replacement cost. Because if there's catastrophic damage and you can't rebuild or don't rebuild, then each owner owns that percentage of the dirt that the condo sits upon. So it's a big loser for the bank to not be able to have that collateral in place. And I think what you'll see is some of these buildings are going to be cash-only buildings. And if it's cash-only, it will affect a lot of buyers' ability to purchase. If they're doing 20% down and financing 80%, it turns into a cash building. Hey, a $500,000 condo, put out down $100,000, do a mortgage for $400,000. That happens a lot. But not everybody's got $500,000 to drop on a condo, and that could also affect pricing. You see, it's not just the interest rate or the market; it's the underpinnings of what's going on with the market. And this is, if something's going to cause prices to drop in certain areas or developments, It's probably going to be due to an insurance related issue, something financial, that's for sure, but not necessarily what you think. It's not the high interest rates that might slow things down. It's things like the insurance and what that brings. So that is absolutely something worth watching. We're coming up that time of year where the home shows and homoramas are going on, and I'd be interested in your comments to know which ones that you are going to and attending, and which ones you find are the absolute best in the area, and maybe that's a topic we can talk about in one of our upcoming episodes. So for the moment, I hope that you guys have an awesome week, and thanks for tuning in to the Black Hole of Real Estate.